We're back. Stocks are falling again after yesterday's big sell-off. And while our next guest expects more pain ahead, he does see one area of the market that could offer a safe haven. Let's bring in Carson Group Chief Market Strategist Ryan Detrick. Welcome back. It's good to see you.
Thank you for having me back, Scott. Appreciate it.
You've been pretty bullish, if I recall. Are you still, or are you wavering because of the market, the price action in this market?
No, yeah, we've definitely been bullish. Still remain there, similar to probably every guest you've had on for the past day and a half. Yes, the calendar is a potential worry. The first rate cuts coming, the election. We all know those things. I'll just say this. Yesterday was the third 2% down day of the year. Obviously, it wasn't very fun for the S&P 500, most stocks in general. But, Scott, look at it. The U.S. dollar was barely higher, okay? If you look at, what happened the last 2 days with high-yield corporate bonds, they're actually higher than they were on Friday. What in the world does that mean? That's this isn't a major risk-off scenario, but some more volatility, it does make sense in September, we think. And October, to be honest. October of an election year is usually pretty rough. We wouldn't be surprised at all if we had, 5 to 7% pullback. Makes a lot of sense.
Well, let's just get to the heart of the matter. Can the market go up if NVIDIA goes down?
Yeah, we think it can. I mean, it's proven that. I mean, it did last week. I know that's just one small example. We're more neutral technology in general. And again, you see what's happening. I love Chris's conversation. We're a little different than what Chris thinks. We do think this broadening out is real. You look at various advanced decline lines hitting new highs. We've got small caps and mid caps. No, small caps is kind of a dirty word a lot of times, but mid caps quietly are doing really well. That's our biggest overweight. So we think, the market can hang in there just fine if NVIDIA has trouble. If tech in general falls apart, sure, that might put a little damper on things, but overall there's still some positives out there. And just one final comment, on Friday, all-time highs for industrials and for financials. That's not what you tend to see, if an economy is truly about to fall off a ledge here.
No, but I mean, there are legitimate questions about the durability of the economy, the labor market, and thus the broadening trade for good reason.
No, you're absolutely right. I mean, look at today's data. I'm going to talk about the jolts. There's some concerns there. You look at hirings up 5%, but hey, layoffs up, over double digits. I mean, so there are some cracks that are out there. And again, that's why we've been in the camp. The Fed probably should have cut last time. No, they did not. But, we think we know the cuts are coming. But we think this is, again, more of a mid-cycle slowdown, not the beginning of a recession. I looked when the Dow hits a new high, go back to 1900. 6 months later, you're in a recession, less than 10% of the time. It's not very likely. People need to remember this. The best leading indicator we have is the stock market on the economy. So the economy might slow down, but with stocks doing what they're doing, it's just hard for us to see a recession the next 6 months or so.
What if the Fed's already too late?
Yeah, well, honest to goodness, they probably are. I mean, if you look at the inflation data, I've come on, with you guys for a while saying that inflation is last year's problem. But again, the Fed's voice goes a long way, and that's a big debate. You've talked about all day. Is it 25 basis points? Is it 50 basis points? I think if it's 50, it's kind of the Fed saying, well, we were behind the curve. Market might not like that. I think ideally a 25 basis point cut with clear, lingo that there are more cuts coming. Again, as every time we see data like today's data. I mean, the jobs data, the employment labor backdrop continues to weaken, so more cuts need to come.
But I mean, if the Fed is already too late, and you admit that they may be, these cyclical areas of the market are the ones that would likely get hit first, right? I mean, if you go right back to the playbook, if I'm worried, well, I'll just play some offense and some defense in the mega caps. Why take the risk elsewhere?
Well, no, you make some good points there. Again, I'm kind of an old school message of the markets person. I mean, we are seeing the leadership. So clearly the message market is not worried yet. But I will say this. We've got advisors in 42 states, and we manage a lot of money at the Carson Group. And we actually added some low volatility ETFs. In a period of high volatility, you want to have low volatility. That's the way you combat that. And what's interesting about these low volatility, yes, there's consumer staples in there and utilities, but it's actually a decent amount when you peel back the onion, so they say, of financials and industrials in there. So that's one way that we've been very bullish for a while, added some low volatility. If we get, again, a little standard volatility scare ahead of the election, we should be okay. But honestly, Scott, we still think financials, industrials are the groups you want to be in the next 6 to 12 months, as this economy is simply having a slowdown, not entering recession, probably accelerate later this year.
Sure, but if you're gonna hang on the message of the market, I mean, the message of staples, healthcare, and utilities outperforming is not exactly the greatest message to hang on, is it?
No, it's not. Now, I'll just push back a little bit. In the fourth quarter 21, what did we see? Utilities were leading. Staples were leading. They were like the only groups really leading, though. But right now, again, what have we seen? Just saw on Friday, right? We've seen industrials. We've seen financials doing well. I know healthcare is kind of that group in the middle. But as long as we are still seeing that leadership out of financials and in industrials, it's hard for us to think that the leading out of the more defensive areas is truly a risk-off scenario. It's probably just kind of what previous guests have talked about, this choppy, well-deserved break could be needed. But again, that's where we're overweight, and we're still in that boat there.
All right, we'll leave it there. Ryan, appreciate it. We'll see you soon.